Okay, so let me share my screen. Okay, so for today's first lesson, right, it will be on the introductory session. Okay, so same thing. We are going to do a recap first and then followed by tutorial question. So you can have a look into your materials, into your slides. Okay, so we are talking about finance. So the first thing that you need to know is the goals of finance. So first of all, when you talk about finance, what comes into your mind is money, right? So therefore, when you say that you are learning finance, that means you are learning about the art of managing money from an individual perspective, right? From a layman term. But we try to define from a technical perspective. Okay, when I say goal of finance, is basically saying that we are referring to how well the managers are managing the funds of the company. Okay, the goals of finance, right, is to maximize the shareholders' wealth, okay, mainly through the increase of the share price of the equity of the firm. So the one that I highlighted in yellow is the goal of finance. That means today, right, when I say finance, we are referring to how managers utilize the funds, okay, to create wealth, okay, to increase the wealth of the shareholders. Who are the shareholders? The shareholders are the people who pump in the money through the business, who invest in the business. Okay, so it is about the art of managing money by fund managers to increase the shareholder wealth by how? By increasing the share price of the firm. Okay, share price of the firm. Here I say that increasing share price of equity of the firm. Equity means shares. Okay, equity means shares. All right, so yeah, so that is the goal of the finance. So I put it at the bottom here as well. The goal of finance is to maximize the shareholder wealth, mainly through the increasing of the share price. Okay, so therefore that is the goal of the finance. Now, in midterms, there will be questions like, for example, they ask you the goals of finance. Sometimes, right, instead of saying share price, I can talk about market value of the share of the company. Okay, it's the same similar thing. Okay, so I can replace the word share price with the market value. Okay, so remember, this is the goal of finance. So moving on, we need to know there are different decisions under financial management. Right, so we say that we look into how fund managers, okay, utilize the money, okay, and what kind of decisions they are making. So there are three main decisions that we can categorize into. The first one is called investment decisions. Investment decisions means that these are the decisions related to the purchase of the fixed assets. Fixed assets as in like the purchase of building, purchase of equipment, and the machineries. We call it as capital budgeting. Okay, so some terms here. The second decision they are usually making on is on decisions related to financial capital, or we call it as capital structure. So that means these are the decisions about how to raise money for the business. Okay, so now some extra notes over here. Okay, let me write on the whiteboard. Okay. Okay, so first of all, we talk about the second decision, which is what we call as financing decisions, or we call as capital structure. Okay. So financing decisions, okay, or what we call as capital structure. Now, when we are talking about financing decisions, we are referring to how the firms raise money. Okay, so these are what we call as financing decisions. We have two main ways for a firm to raise money. Okay, we have two main ways. One is through the debt financing. Okay, we call it as debt financing. The other one is called equity financing. So these are the two main ways, and you are going to learn all this in details when it comes to the chapters at the back. All right. So we have two main financing decisions. We have two ways for the firms to raise money for the business, which are debt financing and equity financing. So what is debt financing? Debt financing means you use the debts, okay, to raise money. Now, when we say debt in finance, right, we are referring to the issue of bonds, okay? So through the issue of bonds, okay? So you see the way of how we refer to some finance terms sometimes can be very different. The debts over here, I'm not referring to the loans. I'm not referring to the loans. I'm not only referring to the loans, I'm also referring to the issue of bonds. Sometimes firms, right, they can actually issue bonds in order for them to raise money for their business. How's the bonds work? So I want everyone to see this one, okay, this situation. Let's say this is Mr. A. Okay, Mr. A is like an investor. He would like to buy the bonds of companies. Okay, so when we talk about bonds, right? Bonds usually start at the price of 1,000. Okay, this is the face value of the bonds. That means that if you want to buy the bonds of the company, you have to pay this amount. Okay, so you see, firms, right, they want the money so they can sell the bonds to the people, like to Mr. A, okay? But the firms will have to promise to pay some interest, or else why Mr. A want to buy? Mr. A might as well put the money in the banks, right? Okay, so therefore, let's say the company say, all right, if you buy my bonds, right, I give you an interest rate of 10%, okay? Interest rate of 10%, okay? So that means every year, okay, let's say assuming every year, okay, the business will give Mr. A 10% of this 1,000, which is how much? 100 ringgit, right? So therefore, currently, okay, in year zero, in finance, year zero means currently, present, okay, year zero. So currently, Mr. A paid 1,000 to buy the bonds of this company. All right, now let's say 10%, right? Every year. Okay. Usually in real life, it is half a year, semi-annual. In exam, they usually ask half a year. But for now, because we haven't learned what is bonds yet, we assume that it is paid every year. Okay. So first of all, in year one, okay, he will get 100 ringgit as the interest returns. Okay. In year two, he will also get this 100 ringgit. In year three, he will also get this 100 ringgit. Yada, 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 until year five. Okay. Every year he get this 100 ringgit, and in year 5, when it mature, he will get back his 1,000 as well. Remember the initial 1,000 that he had paid? Okay, the business will return to him as well when it matures. So how Mr. A makes money by investing or by buying this bond is that he make the returns from this 1,000, 1,000, 1,000, sorry, not 1,000, 100, 100, 100, 100, 100 every year. Okay, so this 100 every year is the coupon payment for Mr. A as an interest returns to him for buying the bonds of this company. Okay, so of course, in between, if let's say Mr. A needs urgent money, he can sell to other people and earn the difference in terms of the bonds price as well. But you don't learn that yet. For now, I just assume, let's say Mr. A buy the bond and hold it until it matures. So that's how he earns money from it. So do you realize one thing over here? This is like how the firms, right, borrow money from investor first. Because let's say I'm the business, I'm the firms, right? I want everyone to, I want money, okay? So I sell the bonds. Everyone give me 1,000, 1,000, 1,000. So therefore, I get this 1,000 from Mr. A. But in the end, I still have to pay him back the 1,000 when it mature. So basically, it's just like I'm borrowing money from investors, okay? So Mr. A will be like the lenders, right? Because basically that investor lend me money, okay? I'm the borrower. So at the end of the day, I still have to pay him back the 1,000. So that's how the bonds work. So this is why when you issue bonds to raise money, that's what we call as debt financing. you are also borrowing money. You are just borrowing money from investor. Okay, so this is how the bonds work. Okay. Now, remember one thing, when I say debt financing, yeah, of course, I'm also referring to loans, like those bank loans that you take to fund your business. So therefore, there's one finance term, sometimes in midterm, right, they might come across some tricky question, challenging question with some use of finance terms. So when you talk about debt financing, right, the word debt financing, okay, that means you use a lot of debt to fund your business. So we also call it as financial leverage. So when you see the word financial leverage, let's say the company is using a high financial leverage. That means I'm referring to that. Okay, the word leverage in finance means that I'm relying on debt to fund my business. Okay. Now, on the other hand, we have equity financing. Equity financing means what? So for now, I want you to remember equity always means shares. That means today you can raise money from the issue of shares as well. So equity financing means through the issue of shares. Okay, today you sell the shares. Okay, let's say for example you public listed your company on stock exchange so that people can buy the shares of the company. So whenever people buy the share of a company, money will be flowing into your business, and that is also another way for you to raise money. So these are the two main ways of raising money, and this is under financing decisions, in which you will learn in more details in terms of calculations when it comes to the chapters at the back. Okay. Okay, continue. Now, the third decision is called working capital management. Working capital management is referring to the decisions that are related to the operating activities, the primary operations of your business activities. That means the operations of your day-to-day day-to-day operating expenses. Okay, like for example, you have to pay for your rental, electricity, suppliers, all these are under working capital management. Okay, so that means that whenever the managers of the company are working on these kind of decisions about payment to the suppliers, payment to the rental, okay, these are what we call as working capital management. So therefore, when I say working capital, right, I'm referring to how much of the liquid assets that I have to pay off the short-term debts. So therefore, when I say working capitals, right, I'm referring into how much of current assets do I have to pay off the current liabilities. So therefore, in your next chapter, you will learn one formula to find net working capital. To find net working capital, you use current assets minus current liabilities. And why is that we have this formula? It's actually coming from the meaning of the working capital itself. That means I'm referring to how much of the current assets that the business has to pay off the short-term liabilities, which we call as current liabilities. That's how we get the net working capital. So this is the formula that you're going to use for the next week lesson. Okay, so some extra things. Now, from the balance sheet, right? Okay, we can have a look into these three main decisions as well. So same thing, let's have a look into some extra notes over here. Now, let's say we look into balance sheet because we're going to look into that in your next chapter. Okay. Okay, so in your balance sheet, so remember, we have two parts. On the left, we put in all the assets. Okay, we write assets on the left, and on the right, we have liabilities and equities, right? So this is why we can say that assets are always equals to liabilities plus equities. Okay, liabilities plus equity. So that's the formula, because both sides must be equivalent to each other. Okay. So therefore, okay, so now we can see the three decisions over here from the, I mean, we can have a look into the two decisions from the balance sheet itself. Okay, so when we talk about the assets, okay, so when we talk about the assets, the purchase of assets, all these are what we call as investment decisions. Okay, when you look into the right hand side, liabilities and equities, that's how we fund the business. So here is what we call as the financing decision. Okay, so from here you can see the two decisions that we have just talked about. Now, in midterm, sometimes they might ask you tricky question. Let's say there's one question asking, there's a company that relies a lot on the financial leverage. Will that increase the wealth of the shareholders? Will that increase the potential wealth of the shareholders? So I repeat the question. Let's say the company is relying on a high financial leverage. Okay, will it also increase the potential wealth of the shareholders? Okay, so what do you mean by this statement? So the answer is yes. Okay, it will increase the wealth of the shareholders, but how? So we say that the company is leveraging, is having a high financial leverage, right? So that means the company is using a lot on liabilities. So that means when we talk about leverage, okay, that means we are referring to the use of liabilities. That means if I say the company is relying on the high financial leverage, that means they are using a lot more on the liabilities to fund the purchase of the assets. So that means today you have more assets because you use more liabilities to fund it. So for equities here, because equities are the money coming by the shareholders, shareholders pump in the same amount of money. They do not increase their funds, but they are having more assets in this company. So therefore, what it means is, yes, it does increase the wealth, okay, of the shareholders, because shareholders still remain the same amount of funds, okay, but what happened is the company has already more assets right now, because those extra assets are funded by the liabilities, not funded by the shareholders. So like untung like that, okay, for the shareholders. And most importantly, that there is no any equity or ownership dilution. Okay, no equity dilution or no ownership dilution. Because if today you sell more shares to get the money, right, then there will be more shareholders coming in. So everyone will have less stake of the business. Okay, the less ownership of the business. But now you do not use that. You use liabilities instead. Okay, so there is no any equity dilution. Okay, so when you use leverage, okay, then there will be no equity dilution, okay, or no ownership dilution. The stake of the shares by the shareholders remain the same, okay, because they are using the liabilities to fund the assets. So this is why in your next chapter, you will start to look into more of the details in terms of the advantages and disadvantages of debt financing and equity financing as well. Okay, these are some extra things here in case you come across this in your midterm. All right, now let's continue. Some terms here, okay, the difference between primary and secondary market. So when we were saying primary market, okay, we are referring to the newly issued shares to the market. Like for example, you want to public list your company, okay, so what happened is you find the broker, okay, you go to investment bank, okay, to to underwrite your company and then to make it into public listed. So when your company is newly public listed on stock exchange, okay, so those newly issued shares are actually in the primary market. So it is the part of the capital market to issue the new shares. So remember, these are the new shares, okay, the new shares initially, okay. So we usually refer to the IPO. IPO means initial public offerings. That means that we are referring to the trade of the new shares. So when you look into primary market, we look into the relationship between the business and the investor. Okay, business want to raise money through new shares. So business sell to investor. Investor are the people who are interested to buy the share of the business. Okay, so we look into the relationship between business and investor. When you look into secondary market, it is basically we are referring to the market where the shares are being bought and sold. That means in this secondary market, we are referring to the trading of shares. And the shares over here, okay, the shares over here are what we call as the existing shares. Not the new shares, but existing shares. Okay, so here we are referring to the relationship between investors and investors. Like for example, let's say I bought the shares of Genting and I don't want the shares of Genting anymore. I go to the apps and put a sell order and sell my Genting share. So therefore, it's the relationship between investor and investor. Okay, so the purchase and the sell of the shares on the stock exchange, not the new shares anymore, but basically about the way or about the transferring of ownership between investor and investors. Far too often, we always hear that when new business are being listed on IPO, on primary market, right? It will start with a very low price, like few cents, okay, very cheap. So you might hear about things like, oh, you know, like some companies, company A or company B are going to be public listed very soon. They are going into IPO very, very soon. Like this year, you have quite a number of companies going into IPO as well. And it starts from few cents. People might say that, wow, it's so cheap. What? Why not we just buy it? Because it's so low, the price is so low, it will sure increase, right? So is it true to always say that any new firms that are public listed on IPO sure will increase over the time? Not necessary. Okay, you can't say that, oh yeah, the price is so low, we buy at the end of the day, you know, it will still increase. We can't say that statement. And in fact, you know, you don't have any historical records to show that how they perform on this wall. You know, because like those records that you have are those data before they public listed. So it's not so accurate. Like for example, Mr. DIY was public listed at the time. Okay, so what happened is you might say that, oh, Mr. DIY seems doing good. Okay, but the thing is, those performance are before they public listed. So you don't have any actual performance you can refer to because it is new to them for them to be public listed. So therefore, we do not know how well they can perform as well. So I give you some extra info here on the right-hand side. You can see these are some of the companies over here that was public listed, okay, went through IPO in 2022. And you can see that in certain companies, right, they are making losses instead. That means that if you buy that company, if you buy the share of the company, you do not make any gains, you make some losses because the share price fall. So you can see here, the gain is in negative. That means making losses. So that means, yes, buying a new firm on IPO market, it still comes with a risk, okay? Comes with a risk in which the share price might still fall down even further, although they start with a very low price, but it may still fall further, okay? So therefore, this is extra knowledge, not important for that one, okay? Now, moving on to the next one is about agency problem. It's a concept, okay? A concept about the separation of ownership and management. So that means that the people who own the business and people who manage and run the business are two different people. So there will be conflict of interest between the shareholders and managers. Why? Because who own the business? The people who own the business are shareholders. Shareholders, they pump in the money to the business and they own the business. But who manage the business? They are managers. So apparently they both have different interests. Like you see, what shareholders want, we just learned in the first slide. Shareholders want increase in their wealth by how? By having a increase in the share price, right? So that's what the shareholders want. Shareholders want to maximize the wealth, okay? Maximize the wealth by having an increase in the share price. Shareholders want increase in share price. But what managers want? Managers want better salary, better working conditions, better perks, and all these are going to increase the cost of the company. So therefore, you see these two group of people, they have different interests, they have different goals, and therefore it may cause conflicts. Shareholders only care about the wealth of the company, care about the share price of the company, but managers care about some other things else, which are about the salary. So therefore, there will be conflict of interest. Okay, we call it as agency problems. All right, now let's look into some scenarios to see whether the agency problem will be high or will be low in what situations. Now, for example, we are referring to, let's say, a company with a lot of individual shareholders. Now, who are the individual shareholders? Individual shareholders are like the people like us. You know, like when we buy the share of the company, right? We won't buy a lot. We buy very small lots only. Why? Because we are no one. We are just normal people. We only buy a few stake of the ownership of the business. We are not rich. We are not like those mutual funds institution. Okay, so therefore we only buy a few. So therefore, if the company has more of like individual shareholders like us, right? That means everyone also have a bit of the stake of the ownership of the business. So if they want to ask for our opinion, they have to listen to a lot of people. So the goals are less likely to be aligned. So you can think about high individual shareholders like this. So you can think, okay, you can think about like, let's say, high individual shareholders. That means everyone will have a stake of the ownership. Okay, let's say, everyone has one stake. Just okay. Okay, let's say everyone has 20%. Okay, everyone has 20%, 20%, 20%, 20%. Wait. Yeah, I think. Let me draw it again. Okay, so high individual shareholders, let's say everyone has 10%, okay, 10% of the share. So assuming, okay, let's say everyone has 10% of the stake of the ownership of the business. Okay, 10%, 10%, 10%. Okay, some got 20%. So you see here, we have a lot more shareholders here. Okay, everyone has some stake in the business. Okay, everyone has some stake in the business. Okay, so you see, there are so many shareholders in this business. I don't know why this one keeps like that though. Very weird, but the TV is okay, right? So maybe you can switch on the TV. Okay, so that means that if you have high individual shareholders, okay, then what happens is there will be, yeah, it doesn't work. Then have to refer to that one already. Okay, that means that there will be less likely to agree on each other. So less agreement because everyone will have different goals. Okay, so goals are less aligned. So there will be more conflict of interest. Okay, now on the other hand, if the business, right, has more institutional shareholders means that, for example, those big companies like mutual funds company, investment companies, retirement funds company like EPF, employees provident funds. Okay, so all these are big institutions. When they buy the share of the business, right, they buy a lot. Right, they buy a lot. So therefore, if the business has more of these kind of institutions as the shareholders, okay, what happens is there will be less people inside, but everyone has higher portion of shares. Like let's say this one has 40% of the share, this one has 30% of the share, okay? This one have 20% of the share, and this one has 10% of the share. So you see, at least they some of them are having larger portion of the shares. Okay, so therefore, if let's say the business has more of institutional shareholders, then there will be higher agreement, okay? Because easier to align their goals, less people, okay? Less conflict of interest. Okay, so these are just some agency problems. Okay, moving on. There are different forms of business organizations. For this one, you can refer to your own slides to look into the advantages and disadvantages. So when I say sole proprietorship, that means we are referring to sole trader. Okay, that means that you are the one who run the business, you are the one who open the business. Okay, the good thing is fast decision making. You can make your decisions very fast. But the bad thing is there will be unlimited liability. Whatever happened to the business, it will happen to you as well. Like for example, if you are bankrupt, okay, if you can't pay back the loans or pay off the debts, your personal assets will be at risk, okay, because the banks can take up your personal assets because sole proprietorship, right, there will be unlimited liability, okay, so therefore your personal assets will be at risk in the event of business failures, okay. The second one is general partnership. General partnership means you get some partners, one to three partners like that. So the good thing is you have more people helping you, and you may get more money because you are three people sharing money together to open the business. Okay, but the bad thing again, same thing, unlimited liability. Whatever happened to the business will happen to you as well. So because like unincorporated business, I put it over here. So unincorporated business means that there is no separate legal identity between the owners and the business. Okay, that means whatever happens to the business will happen to the owners as well. And there's no continuity. That means that in the event if one of the owner pass away, then the business will have to stop. So that's the drawback of sole trader and partnership. Okay, on the other hand, we have corporation. Corporation means like business. It can be divided into private limited company and public limited company. Private limited company means like, for example, family business, in which you can only sell the share to your relatives, to your family members, to your friends, but not the public, not the general public. But on the other hand, public limited company means like those they are listed on the public stock exchange. That means you can buy the share of the company, like Sunway, Genting, okay? All these, you are allowed to buy the share of the company. So therefore, when you look into corporation, the good thing is it is incorporated business. It's a business with limited liability. There is a separate legal identity between the business and the owners, okay? But the drawback could be agency problem, because the people who run the business and the people who own the business are different people, okay? And there could be double taxation as well. Double taxation means that because like when you look into all these companies, right, they will pay dividends if the business is doing good, right? So dividends is also a source of income. When you declare the source of income, you will be taxed, right? So therefore, double taxation means that, okay, so today, right, when the company is earning money, okay, the company will have to pay corporate tax, okay? But then after they pay out the dividends to the shareholders, when shareholders receive the dividends, dividends is a source of income. They have to pay the tax based on that source of income as well. So dividend will be taxed on personal rate. So therefore, you see you are being taxed twice. Okay, so we call it double taxation. That means income taxed at the corporate rate, and then dividends taxed at the personal rate. Okay, why? Because dividends are not tax deductible. That means that dividends is like something that the company pay after they get the profits. Okay, after they have extra earnings, they pay to the shareholders. Unlike interest, like for example, just now we talk about bonds. Bonds have to pay the interest every year, right? Interest itself is tax deductible. Interest is considered as expense, so it can reduce the amount of tax you have to pay. But for dividends, cannot. Dividend is something that you pay when you have the extra retained earnings. Okay, so therefore, this is why whatever income that's being earned by the company will be taxed at the corporate rate, and dividends will be taxed at the personal rate. Okay, so these are the things that you need to know for your topic 1 itself as a quick recap here. So we are going to look into tutorial question in a while. So before we look into tutorial question, right, I just want to use a quick commit to show you some maybe simple concepts that we are going to come across in the chapters at the back, since today is just a tutorial 1. Okay, so here in finance, right, you come across this term called financial independence and retire early. We call it as FIRE. Okay, so that means everyone want to achieve FIRE is because you want to retire early. Okay, you want to achieve financial freedom. So here there was a story, about why most of us wouldn't achieve financial independence early. So therefore, you can see there are a group of university friends. Okay, so they wanted to achieve FIRE, but what happened is after 10 years, when they met, okay, they do not achieve that. So let's see what's the story about. The first person over here, Adeline. So what happened is, so here you can see that she has a good job. Okay, so she always a driven individual, and everyone feel that she will be successful, and she did well for herself, earning about 12,000 per month. That's quite high. Okay, and by the time she was 30, she was already as a software salesperson at a tech firm. Okay, so she wanted to retire early. Okay, but what happened is, here you can see that she spent quite a lot on commitments. She had an expensive wedding. She bought $1 million of HDB in Queenstown, Singapore, 80,000 house renovation, bought a condo, wanted a landed property, bought a car, and raised 2 kids. Do you realize one thing over here? Too much of commitments. Too much of commitments. So therefore, okay, she couldn't achieve FIRE. Okay, she blindly followed the dream of what we always say. So therefore, too much of commitments on her. Okay, so this is why one of the mistake here. Okay, second here is Adam. Okay, so what happened is he was a fresh grade. He joined a multinational company and he was paid $4,500 every month, which is considered as normal. Like usually when you join multinational companies, that is your starting pay. But of course, this one is in Singapore. But if you put in Malaysia, it's the same thing as well. Like when you join multinational companies as a fresh graduate, yes, it can start with like 4,002, 4,005, like that. Okay, so he joined multinational companies and earned this kind of money every month. Okay, so for March of his 20, he was highly paid and he started to cruise at his job and stopped looking for new opportunities. So he had a basically average life. But what happened is after he reached 30, right, he started to stagnate around 6,000. Okay, cannot go further. The salary was stagnant. Okay, there was a decent salary, but it was not enough to reach his financial freedom. So what mistake did he make? So basically, he didn't invest much, and basically he thought that the salary can grow exponentially, which will not happen, right? So therefore, you cannot assume that salary will go up forever, and there's still a need to invest. Okay, next person is Natasha. Natasha over here, she is very frugal. You can see that from the very beginning, Natasha was very thrifty with her money. She screamed and saved cash and kept in the bank. But what happened is, like what you hear, you always save money in the banks, also cannot cover the increasing cost of living. So however, over the past 10 years, she got her money eroded by inflation. Though she lived way below her means, she also missed out opportunity to grow her net worth. So therefore, her mistake is she saved too much but didn't invest. Okay, so this one is linked to inflation. So this is why you will learn about one chapter about time value of money in your upcoming chapters. It means what? It means that today, right, the money will have more value, okay, as compared to in the future. Because of what? Because of inflation. So this is why investing is important, okay? The next one is Curtis here, the trading guru. So he also dreamed of retiring young and he will earn an average salary most of his life. So what happened is he invests aggressively. So you can see he relied on YouTube and TikTok to make investments, no fundamental analysis and no technical analysis. So therefore, this is like simply investing. Fundamental analysis means we refer to the ratio. In chapter 3, when you learn the ratio, those are fundamental analysis. So I feel that finance, this subject at least is a bit more practical because you will learn all those ratios that can be helpful for you when you wish to invest. Okay, for chapter 3, you will only be using that for assignments. It will not come out in your finals. Okay, for chapter 3. Okay, and technical analysis refer to the graph, the charts. Okay, you don't learn that for now. You will learn that in your higher level of studies. Okay, so therefore this guy did not do any of the analysis. So what happened is, at first when he bought this Tesla and AMC companies, yes, he made some money. Okay, buy low and sell high. But what happened is, sometimes he bought based on luck, so he stuck. He bought at a very high price and started at a very low price. So therefore, he took too much of risk and lived a life based on unrealistic gains. Okay, last one. Okay, this guy here, he attained the FIRE. That means he achieved the financial independence and retired early. So what did he do then? So you can see over here that he basically lived as a kiamsiap life, a stingy life. Okay, so you can see that here is basically they are trying to show you that he has less commitment. You can see that he has no car, no kids, okay, and bought a cheap flat, a normal flat, simple wedding, and so on. Okay, so they are trying to show you that at least he has less commitment. Okay, so therefore, okay, that's just a quick story to show you some of the concepts that you might come across later on when it comes to the chapters at the back. Okay, so not so important for the comics one. Yeah, so these are the things that you need to know for your topic 1. Okay, so now we can have a look into the tutorial question. Okay, question 1. The financial management decision process. Okay, what are the 3 types of financial management decisions? For each type of decision, give an example of a business transaction that will be relevant. So we have 3 decisions. The first one is investment decision, which are about the purchase of fixed assets, like purchasing factory, purchasing equipment, purchasing technology. Hey, all these are already on the far. In case if you're wondering, everything is on the drive folder. Okay. Second one is financing decision. That means either you use equity or the debts to raise the money. Okay. And the third one is working capital management. That means we are referring to the money, the decisions that are related to the day-to-day of the operations of the business. For example, you think about the money to pay for suppliers or the money to be collected from your customers. All these are what we call as working capital. Okay. Question number 2, what goals should always motivate the actions of the firm's financial manager? So that means we are asking about the goals of the finance, which is to maximize the wealth of the shareholders by how? By having higher share price. So you can see the keywords over there, share price. Okay. Okay, next question, agency problems. Who owns a corporation? Okay, describe the process whereby the owners control the firm's management. What is the main reason that an agency relationship exists in the corporate form of organization? In this context, what kind of problem can arise? So basically, they're asking about agency problems. Okay, so who owns the corporation? So the shareholders. The shareholders are the owners of the firm. Okay, so what happened is they will hire the board of directors, the managers. Okay, so they will appoint the board of directors or the manager to manage the business. Okay, so these are what we call as the people who control, the people who run the business. So what happened is, how is that resulting in agency problem? Because there will be separation of ownership between the between the shareholders and the managers. Okay, so therefore this is why there will be agency problems. because managers, the people who run the business, okay, they may act in its own or someone else's best interest, okay, and various shareholders have another interest. Okay, so therefore there will be conflict of interest when they want to maximize the share price of the company. Okay. Now, next question. You have probably noticed coverage in the financial press of an IPO. So you see the word IPO, you know this is primary market already. Okay. Web search company Google is relatively recent example. Is an IPO a primary market transaction or secondary market transaction? So this is primary. Okay. IPO referring to the newly issued shares. Okay. So therefore, it is primary. Okay, next question is about ethics. Okay, so the question here is asking, can our goal of maximizing the value of the stock, so when you maximize the value of the stock, okay, conflict with other goals, such as avoiding unethical or illegal behavior? In particular, do you think subjects such as customer and employee safety, the environment, and the general good of society fit in the framework, or are they just essentially ignored? Try to think some scenarios. Okay, so that means that they are trying to ask if whenever the firms, right, trying to aim for their goals, like for example, to maximize the share price of the company, will it contradict? Okay, will it contradict with other goals? So yes, it will. Okay, so let me just briefly brief you through the answers, because these are the answers directly cut and paste from the textbooks. So sometimes it may be a bit weird. So let me just brief you through verbally. So yes, there could be conflict. Like for example, let's say you want to maximize the wealth of the firms or maximize the share price of the business, right? Okay, so what happens is sometimes there might be certain unethical behavior. Like for example, maybe the business bribe the local authorities or bribe the local government for the sake of getting a contract. Okay, so you see, these are what we call as unethical behavior. Or like for example, whenever the business want to save costs, right, they go and exploit the workers, hire child labor, or like provide bad working conditions. So yes, when they want to aim for their goals, it may contradict with other objectives, like they ignore the ethic practices. Okay, so therefore, if it's in a normal market, right, there are two arguments to look into this issue. In a free market, people might say that if you do something bad, people might boycott you. Okay, like for example, a long time ago, they were saying that Top Glove, they provide bad working conditions for the low skill workers, the bad living environment for the foreigners, for the low skill workers. Then people will have this kind of perception towards the company, which is not good, because when people boycott you or don't look good on your company, what happens is it will reflect on the share price. So that means what? That means in the market itself, we assume that if you do something bad, people will boycott you, and at the end, it will be reflected on the share price. So you see, you shouldn't ignore all this. Like today, when people found out that you are doing bribery, what happened is it will be reflected on your share price in the end. Okay, that's one way for you to see. So that means that business should not avoid, should not ignore all these ethics practices. Okay, but on the other hand, we can also argue that sometimes they just don't care because they want to save costs. Okay, so therefore, people might just violate with all these rules and then proceed to maximize their goals without taking into account of the ethic concerns. Okay, so there are two different perspectives. Okay, so that's what the question is trying to ask. Because sometimes companies may feel that it's not so worthwhile to go and take into account all these ethic concerns, because it will increase so much of their costs. Like for example, we talk about pollution. If let's say they want to do something that's environmental friendly, it will be very costly. Who is going to bear the cost? It's not worth at all. So they might as well just do some unethical practice and get away from the law. At the end, save money. So this is why there are two different perspectives for this. Okay, next question over here. would our goal of maximizing the value of the stock be different if we are thinking about the financial management in a foreign country? So for this question, remember, the goal of finance is always the same, regardless of where they are. So the goal of finance always remain the same, which is to increase the share price of shareholders. It's just that the way of how you achieve that could be very different because you need to take into account of the social, political, and economic conditions. Okay, goal is the same. How you achieve that is different. Okay, now next question. Corporate ownership varies around the world. Historically, individuals have owned the majority of the share in the public corporation in the US. In Germany and Japan, however, banks, other large financial institutions, and other companies own most of the stock. So that means you can see one thing over here. Last time, individuals own majority of the share, but in Germany and Japan, what happened is banks or those institutions, they own most of the stock in the public corporations. So do you think agency problems are likely to be more or less severe in Germany and Japan than in the United States? Why? Okay, in recent years, large financial institutions such as mutual funds and pension funds, okay, have been becoming the dominant owners of the stock in the US. And these institutions are becoming more active in corporate affairs. What are the implications? Okay, so this is what we have just said in the agency problem just now. So if you have more individual shareholders, then goals will be less likely to be aligned. So there'll be more conflict of interest, more agency problems. Okay, but if let's say you have more institutional shareholders, that means they are the banks, mutual funds. Okay, what happened is everyone has a big stake of the ownership of the business and less people. So therefore, goals will be most likely to be aligned. Okay, so therefore, there'll be less agency problems in the Germany and Japan because they have banks and large financial institutions who own most of the stock in the corporations. Okay, so therefore, that one you can just use it for your reading. Okay, so for today's class, it's just all about theories, no any calculations yet. Okay, next week only you will have calculation. Okay, any questions so far?